All right, so today I'm going to be talking about how we can minimize our taxes using retirement accounts. And the three things that I'm going to be talking about today are, oh, before we do that, these money meetups. So, they're always the first Sunday of the month. They're always at 3 p.m. Pacific, and they're always on Zoom at this link here. So you're welcome to invite any of your friends that want to learn about money. If you or your friends or anyone wants to be added to the email distribution list, send me an email with your email and I'll add it to the distribution list. Those of you who have received it know that these reminder emails are sent twice a month. Once a week before, like maybe on Sunday or Monday or something like that, and one the morning of the meetup, which you may have received this morning. And here's my email, and my website is dollarbills.com, BILZ. And there's also information on the meetups there and articles I've written and all that kind of thing. So today we're going to talk about how tax brackets work, how you can use your retirement accounts to reduce taxes, and how capital gains play into why billionaires pay, they say less taxes, but really have a lower effective tax rate than most working people. So first thing, how tax brackets work. So when you hear somebody making $100,000 a year, most people think that so we have the tax brackets, right? And for single filers, 100,000 is located here in the 24% tax bracket. And for married filers, it's located here in the 22% tax bracket. Most people think the entire 100,000 is subject to that 24% tax and that 22% tax for single and married. But that's not actually the case. In the US, we have marginal tax bracket. And that means that the taxes only apply to the income inside that bracket. So, for example, well, and also the first so many $1,000s of your income isn't even taxable. It's the standard deduction. So for single people, the first $13,850 that you make, which I've simplified to 14,000 here, is the standard deduction. It's 0% tax, right? So it's not even considered taxable income, right? Then the next 11,000 for a single and 22,000 for married is taxed at 10%. And then the next 34,000 for single and 67,000 for married gets taxed at 12%. And then finally, we cap out here at the remainder for single person getting taxed at 22%. So as you can see, it's not actually 22% or 24% for this whole thing. It's portions get taxed at different tax rates, right? And so for this, again, the standard deduction is 0% tax. So the first 14,000 are tax-free, meaning the single person only pays taxes on $86,000 of that $100,000 income, right? And then the next 11,000 are taxed at 10% or $1,100. The next 12% is taxed at, the next 34,000 is taxed at 12% or about $4,000. And in total, a single person making $100,000 a year will get taxed $14,261 for the year 2023 by the federal government. There's other taxes, there's state taxes, there is Social Security, Medicare, all kinds of other taxes. But for now, the biggest chunk is federal, so we're going to talk about that. And a single person, a married person pays $8,236 in taxes, or about 8% of their income, which is very different from the 24 and 22% that most people think that these people will make when they look at the marginal tax bracket charts, right? So these people have an effective tax rate of 14% and 8% respectively. Other considerations, like I said before, are like state taxes. So credits and deductions, you could have the earned income tax credits if you don't make very much. If you have children, you get money back. You have educational tax credits. Like my wife took advantage of this the past 2 years because she's in school. So we actually get our income reduced by the amount of money she spent for school. There's the renter's credit. There's business deductions if you have a business, mortgage and charity deductions if you're itemizing. So if you're itemizing, you can get, like if you have mortgages and stuff like that on your primary residence, you can write off the taxes and it lowers your taxable income, but you won't qualify for the standard deduction here. So that's only for people that aren't itemizing, right? And there's added taxes, the alternative, what is it? Oh, shoot, I forget what AMT stands for. Something minimum tax. You have your Social Security, you have your Medicare, you have your state and local taxes. Places like Boston and New York, they charge you city taxes on your tax form. So these things all have to be added in, right? And another consideration that can lower your taxes is that investment income gets taxed at a lower rate than earned income. And I'll show you this in a bit. But capital gains, qualified dividends, they all get taxed at lower rates. You might not even pay anything federally on those things. And then municipal bond interest is completely tax-free on the state and the federal level, I believe. Correct me if I'm wrong, but yeah. So the second topic we were going to cover is how we can reduce our taxes using retirement accounts. And I encourage everyone to start contributing to a retirement account if you haven't done so already. Now, the most common, the most well-known is the 401k, which depending on if you're a nurse or a teacher, you might have different style 401ks, but the accounts are basically the same and they have the same tax treatment. So you might have a 401k, you might have a 403b, or if you're in the military or work for the government, you might have a thrift savings plan or a TSP. Now, all of these accounts are employer sponsored. Basically, you have to do it through a job. Your employer has to set it up for you. Or if you're self-employed, you can set it up for yourself because you are, your own boss, right? So the contribution limit for this year, 2023, is $22,500. And if you're over age 50, you can put $30,000. That's the entire year, right? Next, we have the IRA. So many of you may have heard of a Roth IRA, and I'm going to cover what Roth is and how it compares to traditional in a little bit. But the IRA stands for an individual retirement account. And if you have any kind of earned income, so if you filed taxes this year, or you will file taxes this year, you qualify to contribute to an IRA. And this is generally the easiest one for most people to get because some people don't have jobs that offer 401ks, but they definitely have access to an IRA if they make any kind of money during the year. So the contribution limit for 2023 is $6,500 per person and an additional $1,000 if you're above age 50. This is called the catch-up contribution. So the government wants people to save for retirement so then they're not poor, they're not indigent in old age, right? So they encourage people, if they haven't saved, they have this catch-up contribution if you're over 50 to aggressively save for retirement. And some people have, at work, they have a high deductible healthcare plan, and they qualify to contribute to a health savings account, which most people only know it as something that you can use for healthcare spending, but it is so much more than that. It is basically the best retirement account out there because it's triple tax advantaged, and I'm going to cover that in a little bit. But for your HSA, you can contribute, if it's just yourself, it's $38.50 a year. And if you have a family, if you have dependents, a wife or a spouse or kids, it's $77.50. And if you're over age 50, add an additional $1,000 for that catch-up contribution. Now, your 401k and your IRA are both amazing retirement accounts, and they have two different types of tax treatment. One is the traditional, which is what most people know, and one is the Roth. So the traditional, it allows you to deduct the amount of money you put in there, reduce your taxable income by that amount of money. So let's say you contributed $20,000 to your traditional 401k or your 403b, or your 401k and your traditional IRA combined, $20,000. That would mean that this person who's making $100,000 would only pay taxes on 80, not the entire 100. And even after that, the amount is further reduced by these, what is it called again? I'm sorry, I'm blanking. The standard deduction, right? And the Roth is after tax. So the traditional is pre-tax, which means you move it to that account before you pay taxes. So it reduces your taxable income. And the Roth is after tax. So you don't get any tax benefits now, but the benefit of the Roth, and the reason why I like Roths, no matter how much you make, is that the entire amount is tax-free as it grows. And when you retire, you can pull any amount of money out of your Roth accounts, your Roth 401k or your Roth IRA, completely tax-free. The downside of the traditional, while it's a very good option for people who who have high incomes and who want to reduce their taxable income now so they have more money to invest. When you retire and you start pulling the money out, the entire amount of your traditional 401k or your traditional IRA are taxed at your then ordinary income tax rate, right? So we don't know what taxes are going to be when you retire. So this is something that, especially the way the U.S. is kind of going to debt, it just makes sense that they're going to raise taxes at some point because they are kind of low right now. So my recommendation for anyone is the Roth, but some people do better with especially if you're in a higher tax bracket or you're closer to retirement, you might do better with the traditional, right? And so here's the tax treatment that I was talking about. So normal taxable brokerage, basically where you buy and sell stocks, you get taxed 3 times. Once from your paycheck, because you buy the stocks with your paycheck money, right? That's your after-tax paycheck money. Once or multiple times when it grows. So every year you're going to be paying taxes on dividends, on interest. And so that's where it gets taxed there. And then when you sell, when you pull the money out, the capital gains, the profits are also taxed. So that's 3 times, triple taxed, right? For your normal, stock trading account, right? Now, retirement accounts are much, much better in that they only get taxed once. If it's the Roth, sure, you pay taxes on your paycheck, but then it grows tax-free. You're not taxed on those dividends or the interest. And then when you sell, it's 100% completely free of tax, right? And your traditional, you get to have more money up front. You get to invest that extra money and have it grow for you. So it's not taxed in your paycheck. It's not taxed when it grows, but when you sell it, it's 100% of it is taxed. And now here's the amazing HSA account. Now, yes, you have to use it only for medical health care expenses, but it is tax-free 3 times. Once when you get paid, so it reduces your taxable income. When it grows, it's completely sheltered from taxes, it's tax-free. And then when you sell, when you pull the money out, which you can do, by the way, at any time you want. You don't have to be a certain age. Like your Roth IRA, your Roth 401k, your traditional IRA, your traditional 401k, those have age limits. Like you have to be older than 59 and a half to start pulling it out without penalty. Otherwise, they're going to charge you an extra 10%. So be very careful with this. So don't pull it out before then. But your HSA, you can pull out at any time, though. If you can, if this is at all possible, pay for medical expenses out of pocket, and then use the HSA as kind of like a synthetic IRA, because that stuff will just grow and grow and grow tax-free. So it's an amazing account if you qualify for it. And the one loophole you have, let's say, I'm covered by the government, I have Medicare, or I have the VA, like I have the VA. I generally don't have to pay for healthcare, thankfully. So I have an HSA, and I don't spend, I try not to spend money from it, I try to pay it out of pocket, right? But when you turn 65, if you haven't spent it all on healthcare expenses, you're able to convert it to a traditional IRA, or it acts like a traditional IRA in that you can pull the money out after 65 and pay taxes on it, just like a traditional IRA. So that's the difference in tax treatment between these types of accounts. So this is kind of what it looks like remember how I was saying that if you contribute $80,000 to your traditional IRA or 401k, it reduces your taxable income? This is kind of what it looks like. So instead of paying taxes on the entire thing other than the standard deduction for a single person, it reduces the amount by 20,000. And then married over here, same thing, 20,000. So instead of paying 22% of 41,000, you're paying 22% on 21,000. Subtract 20,000, right? So another thing you have to consider with your traditional IRAs and your 401ks, including the Roth 401k, is they have a required minimum distribution at 72. So the government wants its money. You can't indefinitely defer taxes, right? So at 72, they're going to force you to start taking a portion of your IRA or your 401k out, and then obviously paying the taxes, so they can get a little bit of tax revenue. But that doesn't count for the Roth IRA. So you've already paid your taxes. The government will never get a dime from your Roth IRA. So they're fine with you not, you can die with it and pass it on to your heirs. Yeah. So your Roth IRA is the one that you want to leave for your children or your whoever you decide to leave your money to when you die. And so the benefits so here are the pros and the cons between traditional and Roth. So the pros, as we know, is it reduces taxable income, you can invest more money, and it grows tax-free. The cons, well, in retirement, anything withdrawn is taxable at your marginal tax rate, which, we don't know what that's going to be. It could be a lot higher, so we really don't know. So that's the con of the traditional. So the traditional IRA, the traditional 401k are generally best for people in higher tax brackets, let's say like the 24+%, and for older people who are closer to retirement. That's who traditional accounts are best for. And Roths, the pro is that you never will pay taxes ever again. And it grows tax-free, just like the traditional, right? The con is that there's no tax savings now, so you have less money to invest. And the Roth is generally better for people in lower tax brackets because I'd much rather pay 12% now if I'm in that tax bracket, which I am. I'm in the 12% tax bracket, and never have to pay anything ever again in my life, than, leave it up to fate, leave it up to what the government decides they want to tax me when I retire. And they're also better for younger people because you have longer time, things may change. So let me give you an example of how amazing a Roth IRA is, and this kind of will segue into my next segment about how billionaires pay less in taxes. But for anyone who's heard the name Peter Thiel, he was a founder of PayPal. So he made billions of dollars by he was like I said, he was one of the founders of PayPal, and he had pre-IPO shares that were worth like a fraction of a penny. And he put $1.7 million shares of PayPal, which was worth just under $2,000, into his Roth IRA. He never invested another penny. He just put those shares in there and let it grow, right? And now that amount, or as of last year, that amount was worth over $5 billion, which means he can retire. He can withdraw the entire $5 billion whenever he wants after age 59 and a half, which will be in a few years, completely tax-free, it's kind of crazy. Like if you made $5 billion, you'd be paying over half of that in taxes. Yeah. So the third topic that we're going to talk about is capital gains. So Uncle Sam, Uncle Sam loves its investors. Uncle Sam is the reason that the tax laws and loopholes are the reason that the rich keep getting richer and the middle class pays a fairly high percent tax rate, right? So before we get started on this part, I want to explain the difference between short-term and long-term. Short-term means you hold the asset for a year or less, and long-term means you hold the asset for more than a year. So let's say I buy some shares of Apple today, and then I sell them tomorrow. That's a short-term profit. If I were to hold it today, or buy it today and then sell it a year and a day from now, that's considered long-term profits. And there is a huge difference. The taxes are completely different. So long-term taxes get taxed at the long-term capital gains tax rate. So it's much lower than short-term. And short-term gets taxed at your normal tax rate. So if you're in the 22% tax bracket, that money's going to get taxed at 22%, right? So if at all possible, you want to hold your investments for at least a year before selling them. So the US government wants to encourage people investing in companies and not speculating with them. So the difference between investing and speculating is you're content. When you invest, you're content with an average or below average risk for satisfactory returns. It's more of a long-term mindset, and the goal is to generate income or appreciation in the future. Speculation, that's like day traders. That's people investing in crypto. That's people buying lottery tickets. That's people who want to get rich quick, right? It's a high risk, high reward, right? It's like that kind of thing. The goal is to make a massive profit quick. And Uncle Sam, the US, he wants people, or the government wants people to invest, not to speculate, right? And they created tax laws to kind of incentivize this. The long-term capital gains, like I said, that they're ones that you hold for over a year before selling, is taxed at a lower rate than earned income. Take a look at this. If you're single, you can make up to $44,625. I'm just going to call it 45K for simplicity, and pay 0% federally on any capital gains. If you're married, up to $89,000 you can make without paying any taxes on long-term capital gains. Then, as you can see here, if you're single, you make above 45K. Between 45 and 492,000, it's taxed at 15%, and then anything above about 500K is taxed at 20%. But the standard deduction still applies here. So if somebody made 100K, we already looked at what they would make, right? They would pay $14,000 in taxes for a single person. If, however, they made 70K in earned income and money they had to work for, and then 30,000 in passive income, just from selling their stocks, the 30,000 would only get taxed at 15% because it's right here, right? It's in the between 45K in income and 492,000 income. So they would pay 12,000 in taxes. And then if they were lucky, if they were maybe retired, they weren't working, they're just selling their shares to fund their lifestyle, they would only pay $6,000 in taxes, that single person, right? So having investment income is much preferable than working for income. Here's something that might blow your mind. You can make six figures as a married couple this year and not pay a penny in federal taxes. How's that? Well, the first $28,000, the first $27,700 of a married couple's income isn't even considered for taxes because it's the standard deduction, right? And then so 28,000, right? And then that leaves 82,000. Oh, I'm sorry. And then the next $89,000 of their income is completely tax-free if it's all long-term capital gains. So a married couple can make almost $117,000 in capital gains and long-term capital gains and not pay a penny in federal taxes. And there's a big asterisk next to federal because California, for example, where I live, taxes investment income at the same rates as earned income. So I don't really get out of that one, but it's still a massive chunk that you save in taxes just by having investment income instead of earned income, right? So that was the third topic that we were talking about. And before we wrap this up, I just want to remind everyone that these money meetups are always going to be the first Sunday of the month, always at 3 p.m. Pacific time, and always on Zoom. And there's that link. You're welcome to invite your friends, and if they want to be added to the distribution list, send me their email or have them send me an email to the email right here, and I will add it to my distribution list so they see these emails. And my website, dollarbills.com, BILZ, also has the information about these meetups. So for you, here's your to-do list. So number one, I want you to spread the word about these meetings. I'm sure other people can benefit from them. Number two, if you haven't done so already, open a Roth IRA. Number three, schedule a money coaching session with me, yours truly, if you feel like you need it. And number four, always spend less than you make and invest early and often. So number three, money coaching session. So if you didn't know, I'm a money coach, just on the side. I'm not licensed or anything, but I do have experience and knowledge to back it up. So if you want help getting your finances in order, or if you need some financial guidance, I do one-on-one personalized money coaching sessions to help transform your finances and transform your life, because money solves 2/3 of life's problems. So I say, devote some time to fixing that, right? And so I charge $50 an hour, which is a lot less than other, financial advisors. And the first half hour, if you're not sure about it, first half hour is free. We can do an assessment, get to know each other. And my qualifications, like I said, are my knowledge, my experience, and an unhealthy obsession with all things money and personal finance. And I also have a degree in finance, which I got in 2017, and an MBA, which I got in 2018. So the topics we covered today are how tax brackets work. The tax bracket, the marginal tax doesn't apply to the entire income, just a section of it. how we can use retirement accounts to reduce taxes, and how capital gains are your best friend. You know, why your tax rate is higher than billionaires.